asymmetry that may exist between the investor and the company that is listing, audit is necessary, and it is one of the requirements of compliance in almost every country. But Somaliland still do not have very stringent rules on audit because they do not have listing. That is one thing, and then probably the tax requirement is not based on financial statement. That is what I can say, because if some imputation of tax is based on is based on financial reports, then it would be mandatory for each and every organization or each and every company paying tax to prepare and to prepare their information in such a way that the taxman can use it as a basis of levying tax. Now, but that notwithstanding, you are the future leaders of Somaliland, so we just tell you how it is done somewhere else, and then you will implement it in your motherland. You will implement it. So nobody can say it's not necessary. It's all necessary for all of us. Okay, so to set the ball rolling, auditors and the audits. So here we are talking about the auditor, the role of the auditor, and what about the role of the auditor and what audits are all about. What are the requirements? What are the qualifications? Which bodies do the oversight for standards now? So we start with some overview. Okay, so overview of the audit now. So we say the audited financial statement, they play a very important part of the financial information that we get when we are in the capital markets. And audited financial statements are also a basis for effective governance. Auditing can briefly be defined in a brief manner. Can be defined as an assurance service that objectively gathers evidence and communicates it to the third party. So it's an assurance. Auditing is an assurance, a service for assurance, and data is gathered, then communicated to a third party. So the third parties would be stakeholders. Now, audit, we can also say that companies are required to prepare a financial report every financial year, and they must have these reports audited. And once the reports have been audited, they have to obtain an auditor's report. And the auditor's report will express the opinion on the audit, whether it is qualified, unqualified, or if the auditor cannot express opinion, etc. Now, so that is a requirement by most, the law in most countries. Now, so large proprietary companies or a big company, then companies, these are companies that are quoted in a stock exchange or that are trading their shares, so that have outstanding shares, they have to appoint an auditor. Small proprietary companies, under normal circumstances, may not be required to prepare this report. Hence, they may not appoint an auditor. Yeah, most of the companies I see, probably it's a family-based company that you don't have external investors, so you may not appoint an auditor. Now, audit function. So the broad function of an audit function. So broadly, the function of an auditor is basically to conduct an audit, and this audit is on the financial affairs of of a company, financial affairs of a company. And financial affairs of a company, the whole idea is to ensure how to ascertain that the financial report that the company has provided complies with the relevant legal requirements. It also complies with the accounting principles, and it's also a true and fair reflection of the affairs in all material respect of that company financial affairs. So this audit is very, very important. It's very, very important. It's very, very important. So to give us the true position of a company affairs, financial affairs. Now, so audit role in this case. So the main audit role is to provide the financial information reported by the company is free from material misstatement. So that assuring it's an assurance chances of fraud or carelessness or negligence by officers of the company. Now, officers of the company, we know that they include from the director all the way to the sweeper in that particular company. Now, the auditor will provide that barrier of protection. Now, in order to fulfill this role, the auditor must have certain skills or expertise, and the auditor must also be independent of the company they are auditing. So the issue here is skills and expertise, and then independence. That is when the audit will be of importance or will be of great importance to the users. Now, audit role again. Now, the main auditing requirement is basically to provide an audit report to the members of a particular company. So these members are basically shareholders in the financial report for a particular financial year. So audit report is part of the financial report. The audit report, the auditor, if you look at the audit report, it appears one of the first pages to inform the user of that particular financial information that whatever you're using is free from material misstatement, giving the user the assurance that the information they have at hand is accurate, reflect true and fair affairs of the entity they would be interested in scrutinizing its financial affairs. So the audit appears in the financial report, and then the audit will include: one is whether the financial report is in accordance with the law, including compliance with the accounting standards, and whether the report provides a true, fair view of the financial position and the performance of the company. With the accounting standards, then it is upon the report must, to the extent it is practicable to do so, must quantify the effect that must quantify the effect that non-compliance has on the financial report. Now, if it is not practicable to quantify the effect fully, then the report must state why. So it is upon the auditor to bring bring forth if compliance, if non-compliance can have some effect. If possible, you have to quantify it. You have to put it in quantifiable terms, quantify the effect that non-compliance has on the financial report. If it is not practical to quantify the effect fully, the report must state why. That is a legal requirement. Now, third, it's also required that given all the information and assistance for the conduct of the audit, and then any defect or any irregularity in the financial report, and whether the company has kept financial records sufficiently to enable an audit to take place, and whether the company has kept other records required by law. Now, the legal requirement. Now, the auditor's role does not extend to commenting or passing judgment on the soundness of the business and the financial decisions of the directors and other officers. That is not the auditor's role. The auditor's role is just to ensure that the information provided complies with the law and the accounting standards, and it is a true, fair, true picture of the company. Now, we normally know, so we say audit role and corporate governance. That is our interest today. What is the audit's role in the company and the corporate governance? Now, auditors, they do not prepare company reports. That one, you know, their role is just to verify that the reports are accurate. So their role is one of checking or verifying. And then in this respect, it has been noted that an auditor is a bloodhound. A watchdog will signal. The role of a watchdog is just to signal that there are some intruders. You see, if you have a watchdog, then a bloodhound will now do the prosecution. If the intruders are coming in, the bloodhound will attack, or will attack the intruders and do the execution. So the role of the auditor is basically to signal that something is right, something is not right. Now, the audit function is an integral part to the activities and affairs of the company. So a company exists alongside audit. Audit must be there. As a company does its affairs, then a parallel line will also run that is verifying whatever has taken place. Now, although the audit role can be defined relatively easy, it is a role that has various junctures, that at various junctures been perceived not to have been fulfilled well. Yes, I can bring you back to our case, Enron and Anderson. If you read that case properly, it had something to do with the audit, the audit service and the non-audit service. And because of the Enron company, the corporate governance issues have changed, and the audit requirement in corporate governance is now more comprehensive and well defined. Now, the audit role in the past had not been done well because of lack of independence of the auditor. In the previous decades, auditors were never known to be independent, simply because the clients, they had a client, the client relationship was such that it limited carrying out the watchdog function. So audit on the corporate governance, if we continue in looking at the nexus, the link between external audit and corporate governance, the auditors play a significant role in corporate governance. And it's not surprising, given the emphasis placed on integrity, financial report that is honest and that presents a balanced picture of the state of companies' affairs. Balanced picture of the state of the company's affairs. Now, so this audit function is very, very important. Now, Cadbury report. Cadbury, if you know, Cadbury is one of the biggest companies in the world in terms of chocolate. So the Cadbury report Cadbury report, let me just Cadbury report. The annual audit is one of the cornerstones of corporate governance. That is as per the Cadbury report. And the audit provides an external and an objective check on the way in which the financial statements have been prepared and presented. And it is an essential part of the checks and balances required. Now, the question is not whether there should be an audit, but how to ensure its objectivity and effectiveness. So here in corporate governance, you can see that the whole idea is not whether there should be an audit. That is not the point. The point is how should it be done in such a way that it is how can it be done in such a way that it is objective and effective. How can it be done in such a way that it is objective and effective? So that brings us to the issue of audit independence, because without independence, there can never be objectivity and effectiveness in whatever we are doing. If you're not in that, you can be swayed by other means or other stimuli or other factors, such that you do not arrive at the correct determination which you ought to have arrived at in any undertaking. Now, the audit independence is a critical element going to the credibility and the reliability of an audit report. Now, we can only rely on a report, an audit report, and we can only consider it as credible if it was arrived at by an independent-minded auditor. Now, audited financial statement, they play a key role in promoting the efficiency of the capital market, and the independent audit constitutes the principal external check on the integrity of the financial statements. Yes, so the independent audit, it provides the external check on whether these reports are true. And these reports, you see in the capital markets, the financial reports are a major input in decision making on whether to invest or not. Now, these reports must be accurate. And now, so when we continue with these functions of an independent audit in relation to the capital markets, Now that places us where it places us squarely within the precincts or within the province of corporate governance. Now, how important, what's the role of corporate governance? I mean, independent audit on capital markets. So one, it will add value to the financial markets. Some financial statements such that the users will have all the confidence to use these statements, and the users will also gain by making the correct decision, which is based on accurate information. They add value to the capital markets by enhancing the credibility of these financial markets, financial statement. So first, they add value to the financial statement, and then they add value to the capital markets by enhancing the credibility of these financial statements so that people can rely on them. They enhance the effectiveness of capital market in allocating valuable resources by improving the decisions of users of these financial markets. So whoever wants to invest, whoever wants to give out a loan, whoever wants to buy shares, whoever wants to buy bonds, can rely on the information garnered from audited reports that have assurance, have credibility, have integrity. Now, they assist to lower the cost of capital to those using audited financial statement because they reduce information risk. So they lower the cost of capital by reducing information asymmetry. Now, if the information asymmetry is high, then the cost of capital will definitely go up because the risk arising as a result of misinformation must be catered for by increasing the costs. Yeah, the risk will increase the cost. Now, responsibility of auditors to maintain independence in carrying out their function was also stated by the United States Supreme Court. The United States Supreme Court, so they stated that the independent public accountant performing this function, performing this special function, independent public accountant performing function owes allegiance to the corporation's creditors, the stockholders, as well as the investigating public. So that was what the Supreme Court of America stated with regards to the independence of an auditor. Now, it went further to state that this public watchdog function, so the function of an independent auditor is a public watchdog function, demands that the accountant maintains total independence from the client at all times and require complete fidelity to the public trust. So they have to put their trust, the public has to put on the independent auditor's function. Now that was a pronouncement by the American Supreme Court on the independence of an audit. Now, the general requirements for audit independence. So, what is it that will be required for an auditor to be independent? What is it that will be required so that we say an auditor is independent? Now, the general requirement, they prohibits, these requirements, they prohibit an individual auditor or audit company from engaging in audit activity in relation to an audited body at a particular time if, one, conflict of interest situation exists in the relationship of the audited body at that particular time. So before an auditor engages in an audit, they have to ensure that there is no conflict of interest. We know conflict of interest arises when there is what we call fiduciary relationship between, in this case, the client and the auditor. The auditor shows that the conflict of interest situation exists. So if the conflict of interest situation exists, then that will compromise the independence of the auditor. Now, the individual auditor or the audit company does not take all, if the auditor, the audit company does not take all reasonable steps to ensure that the conflict of interest situation ceases to exist as soon as possible after the relevant person becomes aware that the conflict of interest situation exists. So independence, for independence to be attained, it would require that if the auditor or the audit company realizes that a situation of conflict of interest may arise, then they have to take the necessary steps to eliminate such a conflict before undertaking an audit, because it will basically compromise their independence. Now, what do we mean by conflict of interest situation? We're talking about conflict of interest situation. Now, a conflict of interest situation exists in relations to an audited body at a particular time if circumstances exist at the time which would, one, impair or might impair the ability of the auditor or the professional member of the audit team to exercise objectivity, partial judgment in relation to the conduct of an audit or the audited body. So now, if there are some impairments, some barriers that may not allow you to basically be able to carry out your work professionally, there could be conflict of interest that will basically impair your judgment. Now, so that is conflict of interest situation. Conflict of interest situation. Yeah. So if the conflict of interest situation will, now, second, if it would give a person with full knowledge of the fact and circumstances, a reasonable ground for concern that the ability of the auditor or the professional member of the audit team to exercise objective and impartial judgment in relation to the conduct of an audit or audited body or might be impaired. So the idea of if circumstances would let us assume that such an impediment would occur, then that one alone is likely to amount to conflict of interest. Now, existence of that one alone is likely to amount to conflict of interest situation. So here we are talking of conflict of interest situation first, and then we go and talk of existence of conflict of interest. Existence of conflict of interest. So circumstances that arise from any relationship that either exist, has existed, or likely to exist between, one, the individual auditor, two, the audit firm or any current or former member of the firm. Now, the audit company, and three, okay, the audit company, any current or former director of the audit company, or any person currently or formerly involved in the management of the audit company, and any of the following persons and bodies. This is the audit firm, and then members. So one, a company, including a person currently or formerly involved in the management of that company. If I was an MD in one company and I become an auditor in another company, there is conflict of interest already. If I'm an auditor in one firm, and then after a while I go to another company, become a director, there is conflicts of interest. So these are existence of conflict of interest. So 2, disclosing entity, including a person's currently or formerly involved in the management of the entity, and then a registered scheme, including a person currently or so. All these situations, with a disclosing entity, a registered scheme, company, not to have gotten involved with the company in a substantive manner in the past, to avoid what we call the conflict of interest. Now, disclosing and resolving conflict of interest. Once an auditor or audit firm has discovered that there's conflict of interest, then there is need to resolve. There's need to resolve, or if possible, if it can be resolved. So the law provides that conflict of interest situation exists in relation to an audited body, while auditor or that company is the auditor or that audited body, then the individual auditor or audit company has to notify the authorities in writing of that conflict of interest within 7 days from the day they became aware of that conflict of interest. Now, it is incumbent upon the auditor and the audit company to notify the authorities, to disclose to the authorities that conflict of interest exists between the company and the client. So that is one way of resolving the conflict of interest the law requires. Now, we have something called rotation of auditors. Now, independence of auditors is compromised when you have one auditor year in, year out. Now, the law or good practice requires that auditors are rotated after a given period of time, so that you can still preserve their independence. Now, when an individual plays a significant role in the audit of a listed company for 5 successive financial years, then the individual cannot play a significant role in the audit of that company for at least another 2 successive years. So if you have been an auditor for 5 successive years, then you have to step down in the 5th year and take a break for at least 2 years before you can be considered to be an auditor again in this particular firm. Now, so the law, this is common with the law mostly, like English law or the common practice around the world, is that the law provides that a person may not play a significant role as an auditor for more than 5 years out of any 7 successive financial years. So that is what the law says, meaning that auditors must be rotated. So audit rotation. Now, disclosure of non-audit services. Now, the issue of disclosure of non-audit services came as a result of Enron, whereby Henderson was doing some non-financial, non-audit services, and they used to be paid. Now, because of that, they compromised and Enron conceal misdeeds in their financial affairs that led to the collapse of the energy giant. Now, non-audit services by auditors to the audited bodies, they raise 2 threats to audit independence. One, self-review threat, such that this situation arises when the auditor may need to review work performed either by the auditor or the audit firm. Now, so this review may not be possible. It's a threat if an audit basis. And then second, the sacrifice of audit integrity in order to procure a more lucrative non-audit work. Now, this is a classic example of what happened this is a classical example of what happened in Enron. The sacrifice of an audit integrity in order to procure more lucrative non-audit work. All right, now, so we move on, or somebody has a question we can tackle before we move on. You have a question? Do you have a question? Or we move on and then we deal with the questions afterwards?
I think we will deal with the questions after we complete in the session.
Okay, fine. All right, okay, fine. Okay, let's continue then. Now, so we have the auditor and the AGM. What is the role of the auditor in the annual general meeting? AGM, annual general meeting. Now, the auditor's role, nowadays, the shareholders are now entitled to probe the audit. Traditionally, they did not have meaningful role to probe audit deeper. Now, they've been given authority to question authenticity of the audit. Now, the company shareholders have been entitled to ask questions of the auditor concerning the conduct of the audit and the extent of the audit report. So the company shareholders nowadays can do what is called audit probe. However, this right is to be considered. So when presenting that report is presented in the AGM, and the auditor must be there to be open to probes. So where the auditor is an individual auditor and is unable to attend the AGM, then the auditor can instead be presented by a member of the audit team who is suitably qualified and is in a position to answer questions regarding the audit. So the auditors must attend, in case of public companies, the auditors must attend the AGMs. Now, audit duties. What are the audit duties? So auditors' reporting obligations include a much wider range of suspected or actual malfeasance. Malfeasance could be malpractice. Now, so the individual auditors conducting the audit will notify the the authority in writing after they become aware of any circumstance. So this is the duty of the auditor. They report suspected or actual malfeasance, and the individual auditors conducting this audit, they notify the authority in writing after they become aware of any circumstance that they have reasonable grounds to suspect what amounts to a contravention of the law, meaning that they must have good grounds that the law has been broken or has been broken. So it's either a significant contravention or a contravention that the auditor believes has not been or will not be adequately dealt with by commenting on it in the audit report or bringing it to the attention of the directors. Now, so the audit duty is now expanding beyond the client and to the authorities, such that if the auditor notices any contravention or malfeasance, then he has to report such a contravention to the orifice. He has reasonable grounds to suspect that there will be contravention of the law, then it is the duty, it's incumbent upon the auditor to report to the relevant authority such a malfeasance. Now, if the auditor, if the malfeasance amounts to an attempt in relation to the audit by any person to unduly influence, coerce, manipulate, or mislead a person involved in the conduct of the audit. So if the auditor, there's somebody who is trying to put brakes or barriers for the audit to be successfully concluded, then the auditor can report such cases because that is a contravention of the law. And if the malfeasance amounts to an attempt by any person to otherwise interfere with proper conduct of the audit. So if anybody is trying to interfere with the audit, then probably we have to, the auditor has to report. So that is the duty of auditor. Now, on the other hand, what are the liabilities? The liabilities of an auditor. So the auditors may be legally liable. Then the aggrieved party may constitute a legal suit to get redress. So auditors' liability. Now, auditors may be legally liable where they do not properly discharge their legal duties. Now, this liability can arise in three main areas. One of them is breach of contract. So if the auditor does not perform his duty well, as per the contract between the auditor and the client, then that can amount to breach of contract, and the auditor will be liable for the damages caused as a result of such a breach. So the auditor can be liable for breach of contract if the audit function is not performed adequately as per the expectations. 1. 2, negligence. So if the auditor on his part, first the law provides, law and negligence provide that the auditor will be liable to third parties to whom they owe a duty of care. Third parties not even, so anybody who may be interested in the use of that information, if the information carries material, if inaccuracies, then the auditor will be liable. Third party liability, not only to the auditor, but the people who may be interested in this particular information, including regulators, investors, etc., bankers. Now, if they do not complete the audit to the standard required of a professional auditor, and the other party suffers loss as a result of their negligent audit, then they will be liable. So to this end, it is noteworthy that existing case laws, the case laws or the precedents that are there, they've held that not only do auditors owe a duty of care to the company, but in some cases, the duty may also extend to shareholders that are third parties, shareholders. Now, then there's what we call breach of statutes, breach of the law. So the auditor can also be held liable for breach of statutory duties. So where an auditor breaches duties imposed on the audit by statutes are the law, so the company can sue for damages for breach of this duty. Now, if the auditor breaks the law, they become liable. So in these circumstances, only the company may sue, given that the statutory duties are enacted in order to protect the company. The company that is the client. Now, so audit duties. Now, how registration of an audit company? What are some of the requirements that are needed for an audit company to be registered? Some of the requirements. So, some of the requirements. So registration of an audit company. Now, a company may only be registered as an authorized audit company if they fulfill the following conditions. Now, one, each of the directors of the company is a registered company auditor and is not disqualified from managing a corporation under the law. So the directors must be registered company auditors. And then two, each share in the company is held and beneficially owned by a person who is an individual or the legal representative of that individual. That is the second. And then the third condition is that a majority of votes that may be cast at the general meeting of the company are tied to shares in the company that are held and beneficially owned by individuals who are registered company auditors. And then fourth is that the regulatory authority is satisfied that the company has adequate, the appropriate professional indemnity insurance, and that the company is not an externally administered body. It is within the locality. So those are the 5 points to consider when registering an audit company. Then we have what is called proportionate liability. Now, what do we mean by proportionate liability in terms of this audit? So the proportionate liability for misleading and deceptive conduct applies to a claim for damage. Now, this applies to a claim for damage if, one, the claim is made for action for damages, for economic loss or damages to property caused by the conduct that contravenes the law. That would be misleading or deceptive conduct in relation to financial service. Then there will be proportionate liability. And then two, economic loss or the damage to property was caused intentionally or fraudulently. Then there will be application. Now, then we have qualification of auditors. It varies. This is the competence that is expected of an auditor. So in this case, the minimum competence, standard-based practical experience for auditors in order to enhance public confidence in audits. So one, providing that the practical requirements for registration may be satisfied, and by completion of all components of a competence standard in auditing. And then two, revising education requirements for registration to include completion of all specialist courses in audit, and making auditors continue registration subject to compliance with any conditions that may be imposed by regulators according to the law. And then fourth, replacing the requirement for auditors to lodge what is called triennial statement. Triennial, so that is 3 times in a year, with the requirements to lodge an annual statement, and then revising matters that may be referred to the company's auditors, and liquidators disciplinary board in light of the above. So now those ones are some of the qualifications that are required for an auditor. Then we have what is called audit oversight. Now, the audit oversight, these are bodies that will ensure that some audit is carried out as per the audit. So the audit oversight is carried out with some statutory bodies created to oversee audit independence requirement and audit standard setting. So the Audit and Assurance Standard Board are mandated to carry out oversight. Now, the function of oversight will include one, monitoring and assessing the nature of all adequacy of all adequacy. There's some mishap here in terms of slide. Let me go straight to monitoring and assessing the nature and overall adequacy, and then we come here. One, that the system and process used by the auditor to ensure compliance with audit independent requirements, and the professional accounting body for planning and performing quality assurance, reviews of audit work, investigation and disciplinary procedures of the professional and accounting bodies, and accounting bodies, and then the oversight and accounting bodies, and then finally we have what we call the audit committees. The audit committees, you've seen that they are an integral part of the audit committee is an integral part of our corporate governance. We must have an audit committee comprising of directors to ensure that compliance is adhered to by the corporation. So an effective audit committee is basically a committee of board of directors, and they play a critical role in financial reporting by overseeing and monitoring management and the auditor's participation in the financial reporting process. Their role is basically to increase the credibility of the financial reporting process by monitoring the optimistic selection of financial accounting bodies, and then meeting regularly with internal and external auditor, at least occasionally in the absence of management. So by doing that, they get some objective view of the company. All right, now I think that would be okay in terms of our presentation. So you can come with you can now raise issues, and then we see. Then you will see.
Yeah.
Yes.
Yeah.
Can you raise issues?
Yes, I have some issues which related to the subject, specifically the auditor, and also the institution is
Yes.
Financial issues.
Yes.
And also I have example of the Imron.
Yes.
For example, the Imron company violated the GAAP principles,
Yes.
China accounting principles, through the incorrect accounting for the special purpose entity, include the failure of consolidated selective use of the equity methods. Number 2, failure of the provide the complete disclosure.
Yes.
Number 3, failure of the GAAP. Number 3, as did not also consider the fairness of the principles. So there's a rules, the state rule, and also the federal rule. There's and also I have seen somewhere there's a English common law that they use most of the companies, and these events, audits, and also the institutions may have been something which is new or never happened before, like this company. So how it can be also, my question is, how can be also prevented, and the way that can be to think as a, now we are learning as finance students, we are going to learn so many things about the issues that may arise or might come in the future, or also may happen to us. So in the way that we can also protect and also we can mitigate the risk of the financial disclosure. That's one point. Another point, that the case study or the assignment that you sent us was two companies. And
Yes.
when the two companies was investigated, one company they said this company is convicted as guilty, while other is not found guilty. For example, Imran conducted misleading outsiders and misrepresented this financial situations
Yes.
under the law of the USA. And misleading misrepresentation is not necessarily crime in USA. For example, if they
Yes, it is.
yeah, while
It is. Yeah, it is not a crime, but you see, we call them misdemeanor.
yeah.
Some misdemeanor.
Yeah, and another company, which is Anderson, was found guilty because his committed a crime of obstruction of justice and having destroying the potential evidence of the documents. Yeah,
Yes, because a crime is covering up.
yeah. And also, if you compare the two companies, one company lost millions of dollars. For example, Anderson was very famous and also 21,000 staff are working with that, and also their shares and also their passion is they invest in the company to get profit and also get and you know the impacts of the Anderson and also the impacts of the Imran was different.
Yes, because Anderson was the audit company for Enron, but what became so clear about this relationship is that Anderson was doing what we call non-audit duties to Enron. Now, for them to keep good relationship with their client, they kept on giving them some very some very good reports in their favor, with the sole aim of basically maintaining that relationship of this other extra work. So because of the relationship between Anderson and Enron, it became clear that there is need to separate non-audit services and audit services, because this would arise to what we call conflict of interest. So based on that case, nowadays, if an audit firm is not allowed to do non-audit functions to their client, and if such a case arises, they have to ensure that there is no conflict of interest in such a situation. So that is what is so important. Anderson was the auditor of Enron, and they aided and abetted crime. They all went under. Some Anderson, I think those Anderson directors, some of them are still in jail or maybe they've been released, but they were criminally culpable for aiding and abetting crime. Aiding and abetting crime. All right, that is a good observation. I have given you have a number of cases. We should also, when you talk of Barings Bank gives you another perspective of directors' negligence, lack of internal control, that also made the need of the agency to have what you call audit changes in corporate governance with regards to the role of audit on directors. So nowadays, the director's role is not ceremonial as it used to be. Their role is more assertive in ensuring that compliance is met by the company, and ensuring that true and fair position of the company is what is represented to the public or to to any third party. All right, fine. You can. Those are very good observations, and I expect everybody, because our exam will not just be a flat exam. Our exam will be like, with regards to Anderson cases, come out. Can you explain the conflict of interest that existed with regards to Barings Bank? Can you explain the negligence and the role of the directors? Yes. So that is a kind of situation or environment where I want us to operate, and not necessarily just operating at like a textbook. So that's very good of you, Mr. Arden. Any other question to other students? Any other question? Any other question? Yes. No question. Okay. Interesting. Fine. If there are no questions,